In this video, we're going to talk about trend lines, which are sloping lines of support and resistance. Now, trend lines are a very effective charting technical analysis technique because what they allow us to do is project turning points in the future. And these could be support and resistance lines that don't really exist yet in the market. So for example, if you're using the horizontal lines of support and resistance, and you can see that price has reacted at this level once in the past, and the next time price comes back to it, then you're anticipating that it will react again, okay? But these are price levels that already exist. With trend lines, you're able to project price levels that don't necessarily exist yet. So they kind of exist in the market's imagination because a lot of people use trend lines, but they haven't actually been established yet. All right, and I'll show you what I mean by that in just a few ticks. So as I said, they're sloping lines of support and resistance. They're just like any other support and resistance level. So like your Fibonacci's, your horizontal lines, maybe even moving averages if you use those as dynamic forms of support and resistance as well. What ultimately they do is they help us project a point where we believe the market may come down to or come up to and turn around and continue in the direction of the dominant trend. Or, of course, it breaks through the trend line and you get massive momentum in the counter trend direction because now that the trend has been broken, the new trend is in place and it gives you the first warning signs that, you know, a reversal is on the horizon. Now, the important thing to understand about trend lines is that you only look for obvious levels, all right? If you have to look too hard, it means it isn't there. You really are in any kind of trading, because we aren't big enough to move the markets. We're looking to ride on the coattails of the bigger players. So in order to do that, we need to kind of look to see what it is that they're doing. And they're going to be trading those most obvious levels. So if they're going to be doing it, that's exactly what we want to be doing. We don't want to be trading those levels that only we can see, because that doesn't give us a very good chance of success because we don't have the rest of the market behind us or the big money behind us in that particular trade. Now, one of the things about trend lines, which is similar to the Fibonacci's, is that they shouldn't be used in isolation. Not to say that you can't, of course you can, and there are people out there that do it, but us personally, we prefer to use trend lines in conjunction with horizontal lines of support and resistance or Fibonacci's. If we get a confluence of a few levels in one place, then we're going to be more confident about taking the trade. If we've just got the trend line in place, then as I said, you can take it, but there's not as much behind it as if you have another few levels there, all right? And ultimately, you're using the trend line as a guide as to where price could react. All right. Now, as with everything else in trading, there's no 100% technical analysis tool out there. This is something that will give you an edge. It will give you a clue. And remember, us as traders, we're like detectives. We're collecting our clues. We're trying to build a case for the trade that we're about to take. And this is another one of those clues, another one of those factors that we can use to build our case for the trade. Okay, if you've got a if you've got a trend line in place, a sloping line of support and resistance. Now, how do you draw your trend lines? Now, a few people have different ways of doing this, but for us anyway, what we like to do is we like to connect the wicks of the swing highs or the swing lows. Now, I've put here that you shouldn't cut through candles for the most part. And that's to say that more often than not, you want to try not to cut through the candles. But as we know, the Forex market isn't a perfect place, all right? And because there are different brokers quoting different prices, often you don't know which prices, well, there can be little discrepancies of a few pips here and there. So for that reason, even though I'm saying connect the wicks and don't cut through the candles, I'm not saying don't cut through the wicks of the candles, okay? You can cut through the wicks to an extent. What I really mean here is you shouldn't cut through the bodies of the candles. Make sense? So you want to connect the wicks. You can connect through the wicks for the most part if you're containing the rest of the majority of the price action. So if you need to cut through, you know, one or two wicks here and there to be able to get the major market picture into scope, then that's not a problem whatsoever. Where it does become a problem is that when you're cutting through candles, if you start doing that, then that just kind of doesn't make any sense whatsoever. And it's important to remember that our trend lines, they can be upward sloping or downward sloping. So if you're in an uptrend, you'd be connecting the swing lows. And if you're in a downtrend, you would be connecting the swing highs. And I'll show you more of that in just a few seconds. But before we look at an actual chart, let's just understand how we can trade these trend lines. The first part is that you can trade a bounce off of a trend line. So the same way that the majority of our other systems work, or all of our other systems work, is that we're looking for a big trend to be in place, and we're looking to trade the pullback of that particular trend. And a trend line will help support that pullback. So it will tell us where that pullback is possibly going to be exhausted and where the rest of the market may jump in and push the trade in our particular direction. So the first thing that you can do with a trend line is that you can trade a bounce in the direction of the trend off of that trend line. The other way that you can trade it is that you can trade a break of the trend line. So as opposed to taking a bounce in the direction of the trend, actually you could trade the breakdown of the trend. So where the dominant trend gets exhausted and where you get a bit of a reversal on your hands. All right. And finally, you can use a trend line as stop placement. So if you don't have sort of like a clear level from a swing high or a swing low, you could also place your stop the other side of the trend line, you know, maybe 5 or 10 ticks, something like that. And that's also a very, very nice way to place your stops. Okay. So now we've got the sort of rules in place and we've told you a little bit about it. Let's look at what a trend line actually looks like and how you should go about connecting them. Now, to have a trend line in place, of course, you need to have a trend in place. That means you need to have a swinging market. Okay. So you want swing highs and swing lows in the direction of the dominant trend. Now, the one that we have in front of us on the screen in front of you is an uptrend. So what we're looking to do here is contain the price action, is to connect the swing lows. Okay, so as you can see here, this is the first swing up, momentum in the direction of the trend, a little bit of a pullback, move up, pull back, move up again. Now you only really need one or two, well, you need definitely one. You only really need 2 points, but it's nicer to have 3 points to be able to build your trend line. So if you've got something like this, 1, 2, 3, then you're able to project in the future where you believe price will actually turn around at. So as you can see here, from this image that we have here, the market's moving up, down, up, down, up. The next time that the market comes down to this level, so whether it be here, here, or here, but anywhere around the trend line, we're going to be looking for the market to reverse at that point and continue in the direction of the trend. And if we get it in the right point, and if we use this in conjunction with our Fibonacci, our previous support becomes resistance, our various different entry techniques, then you're putting yourself in the position to take a very, very good trade. Make sense to you guys? Any questions so far? If you do, as always, post it below the video. But what we'll do to wrap up this video here is that we'll just look at a live chart. Now this is the dollar franc daily chart. And as you can see there, it's from the 19th of January through to the 4th of August. So you've got a good 8-9 months worth of price action there. And just take a look at what happens every time the price comes back to this trend line. Now the first time you would have been able to draw this trend line is after this swing high here. After this price action here and the market selling off, when it's down here, you would put your trend line in place. So you'd have your 2 points to start with, 1 and 2. And you'd look for the next place that the market came back to that trend line. If we look left on the charts here, what do we have? We've also got a previous level of support, which is now acting as resistance, in conjunction with the trend line, in conjunction with, if you draw it in here, and I know this because we were trading this at the time, the Fibonacci levels, you've kind of got sort of like around a 50% retracement level over there as well. So you've got 3 major factors supporting your trade there. You have no option but to go short. And look at what happens when you take the trade. Sells off and you're able to make a decent profit. You place your stop above the swing high or above the trend line, and you then look to collect your profits. And again, what happens? The market sells off, goes sideways for a bit, comes back to the trend line, cast our eyes to the left. What do we have? Previous level of support is resistance once, twice, trend line in place, Fibonacci, probably a 382 fib retracement level there. You get the price action, you take the trade, stop above the highs, the market never looks back, and you get paid again. Now I know I'm making this look really simplistic, guys, on the charts, and I know you're saying, well, in real life it's not that easy, but you know what? If you look for the best setups, if you look for the markets which are trading harmonically, like this one here, and this one we were trading these setups in our during our webinars a couple of years ago. So we were doing this live in front of other members, okay? And if you look for setups like this and you wait for all of your technical analysis to fall into place, all of your tools to give you the right signals to enter, then it really is as simple as this. You know, if you're looking at a chart and you don't see this kind of price action, then you're more often than not in a consolidation phase or really untidy price action, and you don't want to be trading that in any case, okay? So I hope you found this useful. As I said a couple of minutes ago, if you have any questions, please post it below the video or post it in the forum or send us an email. Otherwise, I look forward to seeing you on the very next video. Have fun and take care now.